Is UnitedHealth a buy or a sell? Let's get started with the model. This is a large cap company, 479 billion market cap. They're trading at $5.20 a share, and they have 921 million shares outstanding. UNH is the world's largest healthcare company in terms of revenue and market cap. They receive a bulk of their revenue from medical insurance premiums. On December 4th, the company's CEO was assassinated, which has been all over the news since it happened. This company was founded in 1974, which is the same year the CEO was born. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow jumped from 20 billion to 26 billion, but it came down 49% to 13 billion in the trailing 12 months. Net income is the profit or loss on the income statements, revenue minus expenses. That grew from 17 billion to 22 billion, but that dropped as well in the trailing 12 months to 14 billion. Revenue is the sales for the company, and that goes up each year from 285 billion to 389 billion. They generate more revenue than 99.999% of the companies in the world. They also pay a nice dividend of 1.6%, which they can cover 1.7 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 687 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $607 billion. We divide that by 921 million shares. And we get a calculated stock price of $6.58. They're trading at $5.20, so they're trading at a 21% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 11 companies in the same industry as UNH, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx by far, $3.5 billion. They have a decent debt to equity ratio, a little worse than the median average. For every dollar of equity, 80 cents of debt. They pay a dividend higher than the average, less than the median. They generate more free cash flow than any company by far. Cigna is number 2. And if you sum up the other 10 companies' market caps, it's still lower than UnitedHealth. They're trading at 5 times book value, 33 times earnings, which is pretty close to the average, 37 times free cash flow, which is better than the median average. Oscar Health is the best at 3.8. And they have the worst price of sales, 1.2. They generate a ton of revenue, almost as much as CVS, but CVS is not nearly as profitable. And their 5-year annual revenue growth rate is 10%, which is worse than the median average. And their stock price is $5.20, which is between their 52-week low and 52-week high. If you put $10,000 into this company 10 years ago, you'd have $63,000 today, a 20% annual return. To summarize, I have them trading at a 21% discount, ranking 8 out of 10. It's a great stock. Even though it's expensive right now, I still think it's of decent value. Would I buy it short-term and long-term? 8 out of 10. I think it's a good long-term hold as well as short-term. Ratios are so-so, 4 out of 10. And financials are okay. Their revenue is going up, but their free cash flow is kind of low. So 5 out of 10. Let's take a look at their income statement. Here's a third quarter 23, third quarter 24. Revenue went from 92 billion to 101 billion. 77 billion from insurance premiums, up from 72 billion. Products, that's 12.6 billion. Services, 9 billion. And interest income, 1.6 billion. Here's a different breakdown of their revenue. 75 billion, UnitedHealthcare. Optum Health, one of their subsidiaries, 26 billion. Optum Insight, 4.9 billion. And Optum RX, 34 billion. So their total Optum revenue is 64 billion, which is pretty close to their UHC revenue. Of the 77 billion of premium revenue, 72 billion is UnitedHealthcare and 6 billion Optum Health. All their product revenue is through Optum, all 12.6 billion. Their total revenue went up 9% from last year. Product revenue up 22%. Premiums only 7%. Below revenue are their expenses, 66 billion of medical costs, operating 14 billion, cost of products 12 billion. So operating costs 92 billion. Operating income, $8.7 billion, up from $8.5 billion, up only 2%. Net income, $6.3 billion, that's up 4%. And their shares outstanding are down. It was 926 million, now it's 923 million. So their EPS went from 631 to 656. Let's look at their balance sheet. 92 billion of current assets, 101 billion of current liabilities. So current ratio below 1. They have 37 billion of cash or short-term investments, over 100 billion of goodwill. So total assets 299 billion, up from 273 billion. Total liabilities 195 billion, up from 175 billion. Their biggest liability is long-term debt, which is 74 billion. Assets minus liabilities equals equity, 100 billion of equity. They're a really profitable company, 97 billion of retained earnings. Retained earnings is sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at a statement of cash flows. This is for the trailing 9 months. Operating cash flow is down a lot. It was 34 billion, now it's 22 billion. That's mainly due to a drop in net income. Last year was 17 billion, now it's 9 billion. In their investing section, they spent 2.6 billion on PP&E. Someone hacked into the company's computers, so they provided loans to companies to help them get through that cyber attack. They gave nearly 9 billion in loans, and they received 3.2 billion from repayments from those loans. In their financing section, they bought back 4 billion of stock, they paid 5.6 billion of dividends, and they issued 1.6 billion of stock. They added a lot of debt, almost 18 billion of debt. So it looks like they're using debt to fund their dividend and buybacks. Let's look at a company on Simply Wall Street. Its last price, $520, 475 billion market cap, down 5% in the past week, down 2% in the past year. Here's where the stock has been trading since 1990. It was 27 cents a share back then, and it peaked at $6.25. If you just dropped a few $1,000s into this stock, you would have been a millionaire today. Simply Wall Street's valuation is $13.20. They say the stock is 61% undervalued. 26 analysts priced this stock at $6.36. Here's their revenue since 2013. It was $122 billion, and it pretty much only goes up. It doesn't look like it ever goes down. Now it's getting close to $400 billion. They had $17 billion of debt in 2013. Now it's its highest ever, $78 billion. But it's not so bad because their equity is always higher than their debt. Equity over $100 billion. And they have a lot of cash on their balance sheet. About half their debt is cash. And they always pay a pretty consistent dividend, between 1 and 2%. The forecast for 2026 is 1.9%. In the past year, only insider selling, no buying. 90% of the companies owned by institutions and 10% by the general public. Vanguard is the biggest shareholder at 9.25%. Fidelity owns 3%. JP Morgan 2%. And Janus Capital at the very end. They employ a lot of people. It was 156,000 in 2013. Now it's 440,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, Santiago, London Stock Exchange, Lima Bolsa, Wiener Börse, EuroTLX, Santiago, BATS Europe, Sao Paulo Bolsa, and the NEO. So if you want to get a free discounted cash flow model, click on the video in the top right corner. Thanks for watching.